We are looking live at Enphase Energy, ticker ENPH, and it is a scene of absolute carnage just moments into the trading day. The stock is currently trading at $32.09. That is a catastrophic drop of $4.61, or 12.56% just today. This is a stock in free fall, and the intraday action tells a story of pure panic and confusion. The market data shows the stock gapped down hard at the open to $31.70 from a previous close of $36.70. But here is the critical insight that many are missing in the chaos. In the moments after the open, it staged a violent, algorithmic-looking spike all the way up to $37.16, briefly going green and crossing yesterday's close. This was the ultimate bull trap. Anyone who saw that spike and thought it was a buy-the-dip opportunity was immediately crushed as the stock just as quickly reversed and collapsed, hitting a low of $31.52 and now settling near $32. This isn't just selling, it's a complete liquidation, a total breakdown of market structure, and it's happening on what is almost certainly terrifying volume. For years, the common ground, the widely held belief, was that Enphase was the Apple of the solar industry. They were the premium choice, the best-in-class technology. Their microinverters were not just hardware, they were a sophisticated, safe, and efficient solution that solved the old-world problems of central string inverters. If one panel went down, the whole system didn't fail. This technological elegance commanded a premium price, and more importantly, a premium stock valuation. Investors paid a tech multiple, believing this was a high-margin, software-like business insulated from the gritty realities of cyclical hardware. The expectation was clear: unstoppable growth driven by a global green energy transition. Today, that expectation is colliding with a brutal reality. The reality is that Enphase is, at its core, a hardware company tied inextricably to the residential construction and home improvement cycle. And that cycle is being crushed by the highest interest rates in decades. The 12.56% collapse we are watching live is almost certainly a reaction to a disastrous earnings, or more likely, forward guidance that completely pulled the rug out from under investors. The problem isn't the technology. The problem is that the demand has vanished. The residential solar market, particularly in key states like California, has fallen off a cliff. The NEM 3.0 policy change in California effectively destroyed the economic incentive for residential solar overnight, and the high interest rate environment has made financing a new system prohibitively expensive for millions of homeowners. The premium product doesn't matter if the customer can no longer get the loan. What we are seeing today is the market repricing Enphase not as a high-growth tech company, but as a cyclical building materials supplier facing a deep, protracted downturn. The whispers of channel stuffing and massive inventory overhang that have been circulating for months are now an undeniable reality. Enphase and its distributors are likely sitting on a mountain of microinverters that they simply cannot sell. This means revenue is not just slowing, it's reversing. It means future quarters will be plagued by inventory write-downs, margin compression, and brutal price competition just to clear the backlog. The bull case was built on high margins. The bear case is now one of negative operating leverage, where profits evaporate faster than revenue declines. This brings us to the short-selling activity, which is a critical part of this story. Enphase has been a prime target for short sellers for over a year, and this collapse is their validation. The short thesis was never about the technology being bad, it was about the valuation being completely detached from economic reality. Shorts were betting that a company reliant on financed consumer discretionary purchases could not maintain a 70 times earnings multiple in a 5% interest rate world. They were right. The data right now likely shows an enormous spike in short interest, but more importantly, watch the borrow cost rates. When the cost to borrow shares to short spikes, it means the demand from sophisticated bears is intense. They are willing to pay a high fee because they are confident the stock is going lower. For retail investors, it is critical to understand what is happening here. This is not a meme stock squeeze. This is a fundamental, thesis-driven short attack that is being proven correct by the company's own guidance. You can track this data. Look at Fintel or Ortex for short interest percentages and borrow fees. Look at the public fails to deliver data from the SEC. A high number of FTDs can sometimes indicate stress in the system or difficulty in locating shares to short. But in this case, the most important thing is to read the short sellers' arguments. They are not focused on manipulation. They are focused on inventory channels in Europe, on the collapse of demand in California and Arizona, and on the fact that Enphase's revenue growth was pulled forward massively during the zero interest rate bubble. What's your take on the rising short interest? Do you see it as smart money correctly identifying a cyclical peak, or is this just piling on? The discussions on social media platforms like X and Reddit are, as you can imagine, divided. There are the long-term holders who are now deep underwater, urging each other to average down and hold for the long term. Then there are the traders who see the volatility as a nightmare. The reality is that averaging down into a fundamental breakdown is a classic way to destroy capital. The long term for Enphase just got a lot longer. The company must now navigate a multi-quarter, perhaps multi-year downturn where its primary goal is not growth, but inventory management and survival. So what does Enphase actually do? For those new to the name, the company's core product is the microinverter. In a traditional solar setup, multiple panels are linked together in a string to a single large central inverter. If one panel is shaded or fails, the output of the whole system plummets. Enphase's microinverters are small devices attached to each individual panel, converting DC power to AC power right at the source. This makes the system more resilient, efficient, and safer. Building on this, Enphase expanded into a whole home solution, offering the IQ battery for energy storage, EV chargers, and sophisticated energy management software. This ecosystem approach is what justified the high valuation. The company had a brilliant run, with its stock rising thousands of % as it posted quarter after quarter of stunning growth and high profit margins, especially as it took massive market share from its main rival, SolarEdge, which was plagued by its own product issues. But that past performance is now a liability. The market is forward-looking, and the future outlook is bleak. The expectation for Enphase was that its expansion into Europe and other markets would offset the slowdown in the United States. The reality, as implied by today's 12% drop, is that the European market is also suffering from a massive inventory glut. Germany and the Netherlands went on a buying spree, and now the channels are full. Enphase is facing a global, synchronized slowdown. Comment below if you are currently holding Enphase shares. What is your average cost and what is your strategy from here? Are you selling to protect capital, or are you holding on for an eventual recovery, however long that might take? Looking ahead, there are two starkly different scenarios. The bull case, the path back to recovery, rests almost entirely on one thing: the Federal Reserve cutting interest rates. A significant drop in rates would revive the solar financing market, and demand could snap back. In this scenario, Enphase survives the inventory glut, and its premium brand allows it to regain pricing power. The bear case, however, is that this is a structural change. The gold rush for residential solar is over. Utility-scale solar is where the growth is, and Enphase does not compete there. In this scenario, the company faces a long winter of stagnant revenue and margin-destroying price wars just to move its products. The 52-week low is $29.89. We are perilously close to that level right now, and a break below it would open the door to a much deeper slide. Ultimately, the story of Enphase has been transformed. The expectation was that you were buying a revolutionary tech company defining the future of energy. The reality, as shown by the $32.09 price on the screen, is that you own a high-end, cyclical hardware supplier at the very bottom of its cycle. The market has lost faith in the growth story, and the path to rebuilding that trust will be long and painful.